Imagine handing over a huge amount of money, maybe everything you've saved for a house, to someone you have to trust.
Yeah,
In the legal world, well, that trust really hangs on how solicitors handle those funds.
absolutely.
So today, we're going to unpack the rules that, make sure that trust isn't misplaced. We're diving deep into solicitor accounts and the SRA Accounts Rules.
That's right. And look, this isn't just about bean counting. These rules, the ones set by the Solicitors Regulation Authority, the SRA here in England and Wales, they're really the bedrock of financial responsibility for solicitors.
Okay.
Our aim today, well, is to make it super clear how solicitors have to manage money that actually belongs to their clients.
And we're using the Document 9 solicitoraccounts.pdf to guide us. It's got all the crucial details.
Mm-hmm.
So for you, the learner, our mission is simple. Get a solid, easy-to-follow handle on the main ideas and rules for solicitor accounts. We want you to feel, really clued in on why these rules are so important without getting bogged down in jargon.
Let's do it.
Right. So first things first, what exactly are solicitor accounts?
Well, at their simplest, they're the financial records law firms use. But the really critical thing is how they're set up. They must keep two types of money completely separate.
Okay.
There's the client's money funds the firm holds for the client, and then there's the firm's own money, sometimes called authorized body money.
Ah, okay. So like having two totally separate wallets maybe, and you absolutely cannot dip into the client's wallet for firm expenses.
Exactly that.
Yeah.
And the SRA, the Solicitors Regulation Authority, they're the ones who make and enforce these rules in England and Wales precisely to make sure client money is always safe.
Right.
That's why firms generally need two main bank accounts. A client account just for client funds, and a business account for the firm's own money.
Got it.
And this separation, it's just fundamental, especially when you think about the sheer volume of money involved in things like, say, property deals.
Yeah, huge sums. Okay, so we have these separate accounts governed by the SRA Accounts Rules. What's the main point of these rules, and who actually has to follow them?
The main point really is twofold. Protect client money and maintain the high standards of professional conduct people expect. That's vital for public confidence.
Makes sense.
And who do they apply to? Well, pretty much any authorized body, that's the SRA term, that handles client money. So your typical solicitor firms, yes, but also partnerships, LLPs, incorporated companies, even foreign lawyers registered with the SRA if they're practicing here. It's broad.
So basically, if you're handling client funds legally in England and Wales, chances are these rules apply.
That's the long and short of it.
And what exactly do the rules cover? Is it just about where the money sits?
Oh, no, it's much more than that. It covers pretty much the entire life cycle of client money within the firm, how it's received, where it's held, how it can be moved, and importantly, the only reasons it can be taken out. Plus, they cover things like paying interest on client money, which we'll get into, and crucially, the detailed records everyone needs to keep.
Sounds incredibly comprehensive. And I guess these rules don't just float in isolation, do they?
No, definitely not. They're a key piece of a larger puzzle. They sit alongside the main SRA principles, those are the fundamental ethics for all solicitors, and the SRA Code of Conduct, which provides more detailed professional standards.
Oh.
You have to see them together. It all ties back to core duties like acting in the client's best interests, providing proper service, even things like promoting equality and diversity. It's all connected.
And if firms
Oh.
or solicitors don't follow these rules, what happens then? I imagine it's not just a slap on the wrist.
Yes, imagine, right.
Yeah.
Breaching the accounts rules is taken very seriously. It can lead to disciplinary action from the SRA, potentially hefty fines.
Well,
And in the worst cases, yes, solicitor could actually be struck off, lose their ability to practice altogether. It really shows how vital protecting client money is considered.
okay, the stakes are clearly high. Let's dig a bit deeper into the core principles then. What are the absolute non-negotiables for managing these accounts?
Well, number one, as we've said, is that strict separation. Client money and firm money must never mix. That's paramount.
Right.
Then there's the need for prompt and totally accurate accounting. Every penny in and out of the client account needs tracking.
Immediately.
Promptly, yes, and accurately. Also, there's the duty to pay interest on client money when it's fair to do so, unless there's a clear agreement otherwise.
Okay, those seem fundamental. Anything else that's key?
Oh, yes. Obviously, complying with the SRA accounts rules themselves
Yeah.
and the wider ethical standards is just baseline.
Of course.
This involves things like regular reconciliations, checking your records, match the banks, and just meticulous record keeping generally. It's probably worth mentioning double-entry bookkeeping here, too.
Ah, the classic.
Yeah, it's the foundation, really. The idea that every transaction affects two accounts helps ensure accuracy and catch errors.
Hmm.
And, for any newly qualified solicitors listening, getting these rules right in practice isn't optional. It's day one stuff.
Absolutely. So double entry underpins it all. Now, let's get specific. What exactly is client money, according to the SRA? It must be more nuanced than just money from a client, right?
It is, yeah. Rule 2.1 spells it out quite clearly. Firstly, it's money related to the regulated legal services the firm is actually providing.
Okay.
Secondly, it can be money held for a third party, but again, only if it relates to those regulated services.
Right.
Thirdly, money held if the solicitor is acting as a trustee or holds some other specific office or appointment.
Mm-hmm.
And finally, and this is quite specific, money received for the firm's fees and any unpaid costs, but only if it's held before a bill has been issued.
Ah, that before the bill part seems key.
Mhm.
Can we have some concrete examples just to make it really clear?
Yeah. Sure. So picture this. A client pays, say, £1,000 on account towards future legal fees. That's client money.
Got it.
Or a client gives the firm money specifically to pay counsel's fees, but the barrister hasn't been paid yet, and the firm hasn't billed for that disbursement. That's client money.
Okay.
And the big one, probably the most common, is when a client sends funds for a house purchase deposit or completion funds. Definitely client money.
Those really help. So how does that differ from the firm's own money, the business money? What are examples there?
Okay, so business money would be, for instance, when a client pays a bill, the firm has already sent them for work done. That payment is business money.
Right, because the service has been billed.
Exactly.
Mm-hmm.
Or if the firm pays, say, a court fee out of its own pocket first, and the client then reimburses the firm for that exact amount. That reimbursement is business money. And similarly, if a client sends one payment that covers both billed fees and costs the firm has already paid out, that whole sum is business money. The key difference often hinges on whether a bill has been raised or an expense already incurred by the firm.
That separation, client versus business money, seems absolutely vital. Okay, let's zoom in on the client account itself. Rule 3 talks about requirements. What does a firm need to do?
Rule 3 sets out some core requirements. First, the client account must be with a bank or building society in England and Wales. Location matters.
Okay.
Second, the account name must include the word client. No ambiguity allowed. It needs to be clearly marked.
Clear labeling.
And Rule 3.3 is really important. You cannot use the client account just to provide banking facilities. So a client can't just park their money there if it's not related to the legal work.
Right, it's not a general bank account for them.
Precisely. Every transaction has to link back to the regulated services being provided.
And when client money does come in, how quickly does it need to land in that client account? Is there a deadline?
Rule 2.3 uses the word promptly. Now, the current rules don't give a specific number of days, but older rules and guidance often mentioned 14 days as a benchmark. So that's still a useful guide for what promptly might mean in practice.
Okay, 14 days is a reasonable expectation then.
Generally, yes. But there are exceptions. For instance, if putting it in the client account immediately would conflict with other duties the solicitor has, like being a trustee, or if the money is from the legal aid agency purely for the firm's own costs. And crucially, there's an exception if the firm has a specific written agreement with the client or third party about how that money will be handled instead.
Right, written agreement is key there. Okay, what about the other end? When the work's done, money needs to go back. How fast?
Rule 2.5 says client money must be returned promptly once there's no longer a proper reason to hold it.
Okay.
And Rule 2.4 adds that it must be available on demand unless, again, there's a written agreement saying something different.
So clients should be able to get their money back quickly when it's due. Now, you mentioned exceptions. Are there situations where a firm might not need a client account at all? That seems counterintuitive.
There are, but they're very narrow, outlined in Rule 2.2. A firm can avoid having a client account only if the sole client money they ever handle fits that specific definition in Rule 2.1d, money for unbilled fees and unpaid disbursements the firm is liable for.
Okay, that specific category.
Yes. And even then, the firm must not operate a client account for any other purpose. And crucially, they must have informed the client beforehand about how their money would be held. It's a very limited exemption.
Right, so not something most firms dealing with, say, conveyancing or litigation could use.
Highly unlikely, no.
Now, what if a firm gets a single payment that's a mix, part client money, part business money? How do they untangle that?
Rule 4.1 hammers home the separation principle again. Then Rule 4.2 says if you get a mixed payment, you must allocate the funds to the correct accounts, client, or business promptly. Split it up straight away.
Right.
And Rule 4.3 adds another layer. If you want to move money from the client account to pay the firm's own costs or fees,
Yes.
you absolutely must send the client, or whoever's paying, a bill or some other written notification of those costs first. Only then can you transfer the exact amount specified in that bill, and only if there's enough money held for that specific client.
So no dipping into the client account for fees without telling the client first via a bill. That makes total sense. Okay, let's talk about taking money out then. Rule 5. What are the approved reasons?
Rule 5 is quite clear. Money can only come out of the client account for specific reasons. Primarily for the purpose it was held for, like paying the seller in a property transaction.
The main reason, yeah.
Or if the firm receives clear instructions from the client or the third party who owns the money.
Okay.
And lastly, if the SRA gives prior written authorization, or in other very specific circumstances the rules allow, those are the gateways.
And are there checks on these withdrawals? Can anyone just authorize a payment?
No, definitely not. Rule 5.2 insists that all withdrawals have to be properly authorized and supervised within the firm's procedures.
Right.
And Rule 5.3 is critical. You could only withdraw money if there's enough held for that particular client or third party. You can't use client A's money to cover a payment for client B.
What if there isn't enough for client B?
Then the firm would have to make the payment from its own business account, effectively covering the shortfall itself initially. It can't let the client ledger go overdrawn using other clients' funds.
So the firm might end up fronting the money in that scenario. Now, the source document mentions something about advances from the firm, a change from older rules.
Yeah, that's interesting. Older SRA rules used to have a specific provision allowing a firm to advance its own money into the client account to cover a shortfall for a payment, and that advance was then treated like client money. The current rules don't explicitly have that same mechanism. However, they don't explicitly forbid making such an advance from the business account either. The absolute key principle remains. You cannot use one client's money for another. Preventing cross-subsidization is vital.
Got it. So flexibility, maybe, but the core protection remains. Now, what if, despite best efforts, a mistake happens? A rule gets broken accidentally. What's the obligation then?
Rule 6 is unambiguous. There's a duty to correct breaches on discovery. It's not optional.
Okay.
As soon as any breach of the accounts rules is found, it must be corrected immediately. And crucially, if money was wrongly taken out or withheld, it has to be replaced instantly. This isn't just on the person who made the error. It's a collective responsibility for the firm's managers.
Right, so prompt correction and making good any shortfall are essential. No sweeping things under the carpet.
Absolutely not. Transparency and immediate rectification are key.
Okay, let's shift focus slightly to something clients often ask about, interest. What does Rule 7 say about interest earned on client money?
Rule 7.1 establishes the baseline. Firms generally have to account to clients, or third parties, for a fair sum of interest on the money they hold.
A fair sum. That sounds a bit subjective.
It can be, but we'll get to that. The important thing first is Rule 7.2, which provides an out. This duty doesn't apply if the firm has a written agreement with the client or third party to the contrary.
Ah, the written agreement again?
Yes, but it has to be based on informed consent. The firm needs to give the client enough information so they understand what they're agreeing to, i.e. potentially not receiving interest they might otherwise get.
So transparency is key if you're agreeing not to pay interest. But if you are paying it, what goes into calculating that fair sum?
Well, the SRA guidance suggests considering several factors. The actual amount of money held, how long it's held for, whether the funds need to be instantly accessible, and what kind of interest rates are generally available on instant access accounts at the time.
Okay, so it's contextual. And how do firms practically manage this? Are there different methods?
Broadly, yes, two main ways. One is using a designated client bank account. This is an account set up for one specific client's money.
Right.
Here, the bank calculates the interest on that specific balance, and typically, all that interest is passed directly to the client. It's clean, but potentially a lot of admin if you have many clients needing separate accounts.
I can see that. What's the other way?
The other is using a general client bank account, sometimes called a pooled account, where money from multiple clients is held together.
Okay, more common perhaps.
Often, yes. But here, the firm has the job of calculating what constitutes a fair sum of interest for each client whose money is in the pool. It's more complex, calculation-wise.
And what happens to the interest the bank actually pays on that pooled account?
Interestingly, under the Solicitors Act 1974, the firm is allowed to keep any interest earned on the general client account over and above the fair sums it calculates and pays out to the individual clients.
Oh, really? So the firm can potentially profit from the interest?
Potentially, yes, from the difference between the bulk interest earned and the individual fair sums paid out. But they have to do the calculations correctly and fairly first.
Fascinating. So one method is administratively simple for interest, but may be complex with accounts. The other pools funds, but requires careful calculation. How is interest recorded, accounting-wise?
When interest is credited by the bank to a general client account, that interest is actually treated as the firm's own money, business money.
Right.
So the firm would typically debit their client bank account control account, increasing the balance, and credit an interest income account in their business ledger.
Okay.
Then, when they pay the fair sum out to the client, they debit an interest expense account in the business ledger and credit the individual client's ledger account, reducing what the firm owes the client overall, effectively passing the interest on.
Got it. That clarifies the flow. Now moving on to the nuts and bolts of tracking all this. Client accounting systems and controls. Rule 8. What are the must-haves here?
Rule 8 lays down some pretty strict record-keeping requirements. For each client, the firm needs a ledger showing all receipts and payments of client money related to them.
Okay.
It also needs to show any payments made for the client using the firm's own money, and importantly, track all the bills sent to that client. That's Rule 8.1a.
So a complete history for each client.
Exactly. Then 8.1b requires a list showing all the current client ledger balances, basically, how much the firm owes each client in a running total.
A snapshot of liabilities.
Precisely.
Yeah.
And 8.1c mandates a separate client cash book recording all transactions going through the client bank accounts.
That sounds like a fair bit of bookkeeping. What about verifying it against the bank?
Absolutely crucial. Rule 8.2 says firms must get bank statements for all client accounts and their main business accounts at least every 5 weeks.
Okay.
And Rule 8.3 is the reconciliation requirement. At least every 5 weeks, they must compare their client cash book and ledger balances with the bank statements and formally reconcile them.
And if they don't match?
Any discrepancies must be investigated promptly and sorted out. Finally, Rule 8.4 requires a central record of all bills issued to be kept somewhere easily accessible.
Right. Are there any breaks from these rules? You mentioned firms without client accounts earlier.
Yes, those firms that qualify under Rule 2.2 not to have a client account get a pass on some of the specifics in 8.1b and c, the list of balances in the client cash book, logically. But they still need to keep that central record of bills under 8.4.
Okay, so regular checks and balances are built in. Now, what about slightly unusual account situations? Rule 9 mentions joint accounts and managing a client's own account.
Right, so a joint account is where the firm holds money jointly with the client and maybe someone else, like another party in a transaction.
Okay.
For these, most of the main accounts rules 2 to 8, don't apply in full. However, the firm still needs to get bank statements regularly, Rule 8.2, and keep that central record of bills, Rule 8.4.
So reduced requirements, but not zero oversight.
Exactly. And it's similar if a firm is operating a client's own bank account, maybe acting as a deputy under a court of protection order, or as an attorney.
Right, where the account isn't a client account in the firm's name.
Correct. Again, Rules 2 to 8 mostly don't apply, but the firm still needs to get the bank statements, 8.2, perform reconciliations, 8.3, and keep the central bill record, 8.4. So key controls remain.
Okay, that makes sense, adapting the rules for different contexts while keeping core checks. Now, Rule 11 talks about third-party managed accounts, TPMAs. What on earth are those?
TPMAs. There's essentially a way to outsource the holding of client money, instead of the law firm holding the funds in its own client account.
Yes.
A regulated third-party payment service provider holds the money, but acts on the law firm's instructions regarding payments.
Interesting. So the firm never touches the money directly.
That's the idea. Rule 11 sets conditions for using them. The key things are, the firm must not physically receive or handle the client money, and they must ensure the client properly understands the arrangement, including fees, terms, and how to end it.
Does the firm need SRA permission for this?
Not explicit permission, no, but they are expected to notify the SRA, usually by submitting a specific TPMA form.
Why would a firm choose this route? What are the upsides?
Well, there could be several benefits. It might reduce the firm's overheads, potentially lower professional indemnity insurance premiums, maybe lower contributions to the compensation fund, possibly saving on accountant support costs.
Okay, cost savings.
And some argue it's potentially more secure, reducing risks like internal fraud or even money laundering, as the money is with a specialist payment provider.
Right.
But here's a crucial point. Money held in a TPMA is not technically considered client money under the SRA Accounts Rules because the firm isn't holding it. The third party is.
That's a massive distinction. Okay, as we near the end of this deep dive, let's cover how compliance is verified. Rules 12 and 13 deal with accountants' reports and record retention.
Yes, Rule 12 focuses on the accountant's report.
Mhm.
Most firms handling client money need to get one of these annually from an independent accountant.
Most firms, not all.
Not quite all. There are exceptions laid out in Rule 12.2. For example, if all the client money a firm handles comes solely from the legal aid agency,
No.
or if the total amount held across all their client accounts, joint accounts, and operated clients' own accounts stays below certain thresholds, basically, an average balance under £10,000 and a peak balance never exceeding £250,000 during the accounting period.
So, very small amounts might be exempt.
Potentially, yes. But firms must provide the reporting accountant with all the necessary information and access to complete the report.
Yeah.
Rule 12.8. And Rule 12.5 specifies the accountant must be a registered auditor.
And how long do records need to be kept?
Rule 13.1 is clear. All accounting records must be stored securely for at least 6 years from the date of the last entry.
6 years. That really emphasizes the need for good systems.
It certainly does.
Finally, let's bring it back to breaches in ethics. Rules 10 and 11. What's the final word on dealing with mistakes and the bigger picture?
Rule 10 basically reiterates that duty we discussed earlier. Breaches must be corrected promptly upon discovery. It also stresses the importance of reporting breaches internally, usually to the firm's compliance officer for finance and administration, the COVFA, and keeping a log, a breach register.
And the consequences again?
As we touched on, they can be serious. SRA intervention, fines, practice conditions, or even referral to the solicitor's disciplinary tribunal for the most severe cases.
Okay.
And Rule 11 serves as a crucial reminder that these accounts rules don't exist in a vacuum. They're underpinned by the overarching SRA principles, things like integrity, honesty, acting in clients' best interests, maintaining public trust.
The ethical foundation?
Exactly. And the specific requirements in the codes of conduct, which cover behavior, competence, and even things like properly accounting for financial benefits, like commissions that might arise from client work. It all links together.
So it's a whole ecosystem of rules and principles, all aimed at protecting clients and the profession's reputation.
That's a good way to put it.
Well, this has been a really thorough deep dive into solicitor accounts and the SRA rules. To wrap up, what are the absolute key takeaways you'd want the learner to remember from today?
I think, fundamentally, understand why these accounts and rules are so critical. It's about trust and protecting money that isn't the firm's own.
Yeah.
Remember the core principles: separation of money, prompt and accurate recording, dealing with interest fairly, and reconciling regularly. Knowing the definition of client money versus business money is crucial, as are the specific rules for putting money in, taking it out, and the very limited reasons for doing so.
Right.
And finally, always remember this isn't just admin. Compliance is linked directly to ethics, professionalism, and maintaining public confidence in solicitors. Breaches have real consequences.
Absolutely. These rules, detailed as they are, serve that clear, vital purpose: safeguarding client funds and ensuring that foundational trust between solicitor and client remains solid.
Precisely. And maybe that leads to a final thought for you, the learner, to ponder. Consider the tightrope solicitors walk, managing potentially vast sums of other people's money. How do these technical-sounding rules actually reflect a deep ethical commitment to responsibility? What questions does this overview start for you about the day-to-day pressures and judgments involved in legal finance?